Inequality is a loaded phrase. It's an overused phrase of the moment. With us is Anthony Crescenzi of PIMCO and Alan Krueger of Princeton University. Let's dive into this arch theme. Professor Krueger, you are one of America's leaders on this. What is the distinction between a more left view of inequality and a more right view of inequality? If I got you and the esteemed John Taylor of Stanford in the same room on inequality, what would be the distinction?
I think the distinction is what should we be doing about it. I think there's been a convergence over the last couple of decades on the problem. I think there's been a convergence of views that inequality has increased dramatically in the United States, that is not good for the country. There's disagreement, however, about what should be done about it.
What should be done right now? We've had such a, you were in the White House, unemployment was terrible, then it got better. And within that, it's gotten a lot better. Do you just assume lower unemployment rate, less inequality?
Well, I think we've seen in the 1990s that when the economy runs hot, the bottom does better. The only time we've seen a meaningful decline in inequality was from the period in the late 1990s. I think there are many things government can do in the short run and in the longer term. Raising the minimum wage, for example. Minimum wage in real terms is lower now than it was when Ronald Reagan was in office. We're seeing companies voluntarily raise their minimum wage. I think it's time for the government to make sure that their competitors are also paying a fair wage. We could take steps to strengthen unions and representation of workers at work. We can invest in the long run in education, and I think all of those steps will help. The forces that are causing inequality rise, I think, are quite varied. They're partly globalization, they're partly technology, they're partly a change in norms at work, which have made it acceptable to have enormous divergence, which is probably hurting productivity.
And you see that within these announcements this week, including McDonald's.
Yeah.
I mean, it's there.
Very, though, keep in mind that McDonald's news, $1 over the minimum wage, only applies to 10% of McDonald's workers. Yeah. Alan, we've got a great chart I saw yesterday on the Bloomberg terminal. It comes, of course, from the Bureau of Labor Statistics. It shows that incomes grew only for the highest earning 20% of Americans. Tony Crescenzi, is this a problem for GDP?
Yeah, and as Alan said, there are disagreements about how to fix this. Think about what happened after the crisis. 8 million Americans lost jobs, 2 million in the construction trade. The odds of the construction worker getting his or her job back at that time was very low because of the bust in the housing market. What did America do to help? Not much. In the last 4 years session of Congress, the least numbers of laws were passed in about 200 years. We haven't invested in people. We haven't invested in stuff. One quick example. In Germany, a decade ago, they announced a program called Agenda 2010 to try to help bring down the 12% unemployment rate, which has now been cut in half because it invested in people. It gave companies incentives to hire workers part-time, to retrain them for the jobs of today. And now Germany's a major exporter, and its jobs rate's the lowest in decades. So we need to invest in people. We need to invest in stuff. That could mean telecommunications, as President Clinton once said. And we haven't been doing that. So there are disagreements about how to get there, and hopefully in the next 2 years we'll all sort it out and we'll have a new way of moving. So
what's the relationship between the rate environment and income inequality?
A great deal, in the sense that it partly is caused by this lack of investment that reduces growth potential, which is one of the 5 reasons the Fed gave in the minutes to last month.
Can I put on my LBJ hat here? I mean, I'm not going to ascribe it to President Johnson, but the way you goose investment is direct government incentives for companies to spend money. Are we doing that, or should we do that, Professor?
Well, our tax code does that to some extent, but
Agreed.
We should be doing a lot more.
Should we do it more overt?
We should invest more in research and development. I mean, that's one way in which we move our economy forward. We should invest more in infrastructure, which would help.
What is
increase
holding
private
us
investment.
back? I've asked you this question, I think, 8 times.
What's holding us back is politics, as Tony said. We have a Congress which has sat on its hands, hasn't addressed these problems, and we're pushing them further and further into the future, or we're missing this opportunity.
And it can't see the benefits right away, and that's part of the problem with short-term political calendar.
And of course, Tom, this is one of the great criticisms of ultra-low rates. What it does is incentivize a company like Apple, who is awash in cash, to borrow to buy back shares rather than to invest.
Well, and it goes, a la IBM, it goes from financial engineering over to actually running a business. Would you suggest, Professor Krueger, with, frankly, the success of the administration and the success of Republicans in getting this economy going again, that corporations will be incentivized to do traditional business?
You know, I think the corporate sector needs to do its job now. The government's done quite a bit. The government had the Recovery Act. The Fed took extraordinary actions. I think the corporate community needs to get together. They can raise wages. I think we're seeing some social pressure leading companies, a la McDonald's and Walmart, and likewise when it comes to investment. But they should also put some pressure on government to invest more in infrastructure.